Good morning, traders and investors. My name is Roger Scott, and today's Thursday. It is the 24th of June. It's the third trading week of June. I believe we still have another trading day next week. Don't quote me on that. I'm not sure. Me and dates are just not best friends, especially after this COVID pandemic with this whole shift in economy and all that. It's gone nuts. I mean, honestly, time has just started going by so fast. It's ridiculous. So today is the big day. We have a lot of data today. We've got jobless claims, we've got GDP, we've got durable goods, and we've got international trades. I mean, when it rains, it pours. But the big reports are going to be the GDP. They're expecting between 6.4 and 6.6%. Anything stronger than this is going to be fearful that the Fed is going to take action to withdraw. Anything below that is going to be very, very bullish, because then the Fed can pat themselves on the back of their back and say, hey, we're doing a good job. We told you economy is not as hot as it is. In terms of jobless claims, I'm expecting below 400,000. The number has been fairly solid. The average is 395. At this point, even if it goes a little bit higher, it's okay, because it's been doing really well, and the number went down from like 800,000 well into the 400s very, very quickly. It stayed there for a while, but then when it broke quickly. So again, anything 400,000, 395, anything below that is really, 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 really positive. So again, the big reports are going to be jobless claims, GDP, and then to a lesser degree, durable good orders. That's going to let us know how well the inflationary pressure is impacting economy. But again, GDP, jobless claims, international trades, durable goods, we're going to get a really good idea of the picture of our economy today. Keep your eye as we go through this, and as the news comes out in about 1 hour. I'm doing this extra early, like 2 hours before the opening bell, because I like to look at the market way, way into the open. I think the bond market's not really going to do much. I think the bond market is going to stay within this range. As I've been saying, I think we're going to stay choppy. I think this is the peak move, and I think if anything, we're going to come back down to the 50-day moving average. So I don't think there's going to be a lot of new discovery today. I don't see it. But again, I've been surprised by this Fed again. So look for volatility. I would be surprised if price action went above the 146 level. But again, it could hit the 200-day average. But otherwise, the truth is, folks, the long-term trend is down. And until this trend is broken, and it's not going to be broken because interest rates are not going lower, they're going higher, which means bonds are going lower. There's a predominant downtrend in the bond market. So if anything, look for bonds to go back down to the base. And I do believe as we go further into the summer, maybe around end of August, mid-August, beginning of September, a little bit past the time that school starts for most kids, I think that's when that's when the yield is going to start increasing on the interest rates. And we're going to start seeing yield increasing higher rates. So therefore, we will see more downside from the bond market, or if anything, more choppiness. But I don't see bonds moving much higher, because interest rates just don't have that much downside to go. They're right at the bottom. So look for yield to go higher on interest. All right. As far as the economy, we've got an issue here. I know the market's really bullish. I know everybody's thinking the market's overheating, but I'm going to tell you something. It doesn't look anywhere on the inside like it does on the outside. And today I want to talk about the Nasdaq. Now, if you could see here, Nasdaq is making all-time highs right here, the pre-opening session. Matter of fact, pre-opening, we're up quite a bit. We're up almost 200 on the Dow. That's not random. 89 on the Nasdaq, 20 on the S&P. These are not random numbers, okay? These are real numbers that are telling us that the market's becoming bullish. But I want you to see something, and I want you to pay close attention to this. Really pay close attention, because this happened about a week and a half ago on the S&P. So there's only, right now as we speak, only 59% of stocks are trading above 59 stocks. There's only 100 stocks. Instead of using percentage, I'll just use the actual number. 59 stocks are above the 50-day moving average and above the 200-day moving average. That's the 200-day moving average right here. So we are not as bullish as the market appears. This is telling us that we're breaking out right now. But when you look at market internals, this is where we peaked out in April 15th, which was right around. This is when momentum levels were at their highest. Momentum levels right now are a third lower than they were. Look at this. 87 stocks making trading above the 50-day moving average. Right now, 59. I'm going to say it again. 86, 59. That's stocks, percentage stocks. Remember, you're only using 100, so it doesn't matter if we talk percentage or stocks. So there's only 60 stocks trading above the 50-day moving average, and the suckers making all-time highs. So this is very vulnerable, and all it would take is just 2 large caps to start falling off, and this thing would go into the twilight zone. So there's a lot of vulnerability with this price action right now, and you need to be aware of that going into today. I would not be doing my job if I would be irresponsible if I didn't tell you that. I mean, look at this on a long-term basis, on a weekly basis. Let's see, on a monthly basis, we're turning lower. And again, on a daily basis, we peaked out 415. The S&P should have peaked out right here because the Nasdaq should have peaked out right here because on 415, right here, 90 stocks, 87 stocks were trading above the 50-day moving average. Right now, when we're up here, only 60 or 59%. That's not bullish. That's bearish. Also, we're seeing divergence. Not a lot of divergence, but we are seeing divergence. Lower price here, lower, higher. Let me just extend this here. So that's not positive either. Also, when I'm looking at my 90-day breakouts, I'm seeing a lot of overextension. And when I'm looking at my sectors, industrial is looking kind of neutral. Utilities is falling off the cliff. Energy is looking okay. Financial looks like it can bounce higher. But look at basic materials. So, but at the same time, look at healthcare and look at technology and look at consumer discretionary and look at communication. So you want to kind of, the best thing to do right now is not to take big positions because the market is fragmented. The pullbacks are looking a little choppier. The breakouts, let me show you the 90-day breakouts. Look at this for yourself. Overextended, toppy, overextended. Look at that trend. Just looks overextended. Looks way, way, way overextended. And I'm not talking about a major correction, but I'm telling you that this is not great. And again, I'm not expecting a major pullback, maybe just to the 50-day line or to the twilight zone, something similar to what we saw here, but we need that to cool off. And I think we're going to see it. So be very, very cautious. We got the bond market is where we got to look at. We'll know about an hour before the opening bell where we stand. Right now, the Dow's up almost 200 points. We're going to open up in about an hour and 50 minutes, but keep an eye on this, on the bond market. The bond market is the key right here. And again, if the number is too hot, it's going to be fearful. Too hot may be bearish for the market, and cold may be good for the market. Because again, if the number is 7% growth, then the Fed will be like, oh, it's a little too hot. We may have to cool off. But if the number is like 6% or 5%, then the Fed will be, we told you so, it's transitory, it's temporary, we still need to do what we're doing. So again, it can go either way. As far as hot stocks, not a lot of stocks that I'm liking. I'm still liking this Aaron's Holdings on a pullback. I like where it is right now. It's right at the 50-day moving average. The RSI is at 33. Just not a lot of hot stocks, but I do like this AAN and I like this MITK. But this is not a pullback. This is more of a congestion breakout. But I like the fact that it didn't go down much. RSI barely moved. And if you look at the profile of the stock, computer, optical, sort of kind of in the right place for the speculative rally. But again, be very careful. And the only real reason I like this stock, it's a Russell 2000 stock. And if we look at the Russell 2000, it doesn't look overextended like the S&P. It looks like it's still congesting. And I'm actually very bullish on the Russell. And the reason I'm bullish on the Russell is because if you look at a one-year return on the Russell, it's 59%. Look at the one-year return on the SPY, 35%. See that? And the Russell, as you could see here, has been congesting. It hasn't really been doing much. So there's a good, real good chance that we're going to see a breakout on the Russell, especially after this congestion. But be very, very, very careful with the tech sector right now because of this divergence. I mean, 90, 87 stocks trading above the 50-day moving average. 59 stocks trading above the 50-day moving average. There's only 59 stocks. In other words, if we go 10 stocks lower, we're going to be right here, right there. So just a couple of stocks pulling down, and it can take us right to the twilight zone. It's not going to be a big stretch. Be very, very cautious. Now, folks, I've got something exciting and actually something that could really help you in this type of trading action. Look, volatility is picking up after the Fed announced its benchmark interest rates will rise sooner than expected. When this happens, we'll see a massive shift in the market. I'm telling you, it's coming. People who aren't prepared and are overly exposed will get burned. And this is why I like what I'm talking about right now. Former Bear Stearns trader Jeff Zananeri, he created a strategy that allows investors to trade a market that's going up, down, or sideways. Take advantage of the market regardless of which way it's going to go. That's what I love the most. And that's how hedge fund traders trade. And Jeff, he's the real deal. Jeff's strategy is brilliantly, and I mean brilliantly, based on money link found between two stocks. Generally speaking, when one goes up, right, the other is falling, and vice versa. So you always have an instant hedge. You don't have to worry about something unexpected happening in the market because you're protected. And it's easy. It's only two stocks. One you go long, one you go short. It's that simple. You buy call, you buy put. Real simple. Big name Wall Street players have kept these strategies hidden like a secret. But Jeff is giving everyday traders like you a chance to even the playing field. Folks, this is your chance to get an unfair advantage. Are you ready? Are you ready to take more systematic, smart money approach to investing? I sure hope so, because the market waits for no one. Click on the link below and see how it's done. I absolutely love these link trades. And right now, when the market's vulnerable, when the Nasdaq gets a little overbought and stretched out, linked trades is your ticket to really solid profits. Folks, are you ready for a more systematic, smart money approach to investing? I hope so. Click the link below, learn how it's done. Most importantly, if you like this video, if you enjoyed this channel, subscribe to it. Be the first to be notified when we post new videos. Follow the link below. You don't want to miss Jeff. This is it. It's happening today. I'll be there at 1 p.m. You don't want to miss out. Jeff and I will get really into it. I can't wait to see you then. And remember, link trades is the way to go. Bye, everyone. Have a great Thursday. Keep your eye on this GDP data. It could be something.